standing in front of the former headquarters of Lehman Brothers Holdings, where on September 15, 2008, hundreds of Lehman employees were seen exiting the building, carrying their company's belongings. Before filing Chapter 11 bankruptcy, Lehman was the fourth largest investment bank in the United States, following Goldman Sachs, Morgan Stanley, and Merrill Lynch. The day that Lehman Brothers collapsed was the same day that the Dow Jones closed just over 500 points, the largest drop since the September 11th attacks on New York City. Lehman's collapse inspired President Obama's famous words, "Too big to fail." While Lehman Brothers suffered the biggest impact of 2008, few other investment banks fared better. Merrill Lynch and Company Incorporated, located here, was acquired by Bank of America during January of 2009. Other companies, like AIG, which insured massive amounts of risky investments, and Fannie Mae and Freddie Mac, which packaged mortgage-backed securities, were bought out by the U.S. government over the course of 2009. AIG, Fannie, Freddie, all were considered too big to fail. But was the U.S. government's choice to bail out the banks beneficial to the U.S. economy after the crisis of 2008? Controversy continues to surround measures such as the Emergency Economic Stabilization Act and other government programs which were intended to save the financial institutions that were allegedly too ingrained in the United States' political economy to go under. On one hand, unregulated markets and poor decisions on the part of banks' executives caused the crisis. On the other hand, while the banks themselves were at fault, their failure would have destroyed any semblance of stability in the global economic system. The question then becomes, was the U.S. government's choice to bail out too big to fail truly beneficial to the U.S. economy? This presentation argues that the U.S. government's choice to bail out the banks benefited the U.S. economy over the short term and prevented a second Great Depression. Firstly, this presentation will explore the reasoning and decision of the government to bail out the banks following the 2008 crash. Next, we will discuss the effects of the Emergency Economic Stabilization Act and measures like it, and how such actions positively impacted the U.S. economy in the short term, while layering a strong foundation for the long term. We will specifically explore the effects of funding on GDP and unemployment. Finally, we will detail the costs of bailout measures and current returns on government loans and investments. The scope of the bailout speaks directly to the scope of the 2008 crash. The subprime mortgage crisis quickly resulted in a global recession that continues to affect everyday Americans. From September 2008 to the end of 2009, U.S. households had lost nearly $5,800 in income on average, which adds up to an estimated total loss to the U.S. of $648 billion. Over $3.4 trillion was lost in real estate wealth, which translates to about $30,300 per household. This doesn't include the 500,000 additional homes that were foreclosed upon. Even more significant was the loss of 7.1 million jobs at the peak of 2008 due to slow economic growth. 1.6 million people are still unemployed. Given the very apparent crisis that occurred over a very short amount of time, it is understandable that the government would take adequate measures to protect the American people, even at the expense of rewarding the bad behavior of the most powerful banks. The bailout is justified to some extent by this human factor. However, the benefits of the bailout are justified in many areas of economics as well. The Emergency Economic Stabilization Act of 2008, or EESA, was designed to prevent the total collapse of the financial system of the United States as a result of the subprime mortgage crisis, which saw a stark reduction in the liquidity of credit markets worldwide. The EESA specifically sought to stabilize markets following the 2008 crash by authorizing the U.S. Secretary of the Treasury to establish the Troubled Asset Relief Program, or TARP, to purchase troubled assets worth up to $700 billion from any affected financial institutions. While in 2010, the maximum allowance of TARP was reduced from the original $700 billion to $475 billion, the TARP program regardless served to prop up failing financial institutions by providing much-needed liquidity through the government purchase of stock, insuring of debt, and lending of large sums of money. Following the passage of the EESA, the U.S. government spent about $436 billion of TARP bailout cash on 970 recipients. the biggest purchases of which included stock in companies such as AIG, Citigroup, and Bank of America. Beyond the TARP program, the U.S. spent about $187 billion on the Housing and Economic Recovery Act of 2008, which launched a foreclosure relief program and bailed out Fannie Mae and Freddie Mac through preferred stock investments and purchases of corporate debt and mortgage-backed securities issued by Fannie and Freddie. In total, the U.S. government is estimated to have spent about $623 billion on various bailout measures since 2008. First off, the injection of capital into the financial system prevented a second Great Depression and halted the complete collapse of the U.S. banking system. According to the Congressional Oversight Panel, which was established in 2008 to oversee TARP funds, while American perception of the bailout is negative, TARP provided critical support to markets at a moment of profound uncertainty. A study conducted by Moody's chief economist and by Princeton University suggests that had the U.S. not enacted its fiscal stimulus programs, the economic downturn would have continued into 2011 rather than into 2009. So while there is a moral argument to be made about whether taxpayers should be supporting the high-level corporate executives who made risky decisions, the issue is put into perspective when considering how much worse the crisis could have been. The potential impact on real GDP growth supports this claim. The same study conducted by Moody's and Princeton models what the recession would have looked like had the bailout not been put in place. A slump in GDP over 2009 and 2010 shows a peak-to-trough decline of 12% in the model, rather than the actual 4% over 2009 and 2010, pointing to deflation fit to rival the Depression of the 1930s, which saw a decline in GDP of 30% over 4 years, at an average rate of 7.5% per year. Data such as this shows how much worse the crisis could have been. Other data reports that not only was a depression forestalled, GDP increased at healthy rates following the crisis. According to the World Bank, by the end of 2008, the United States was experiencing negative annual real growth of GDP of negative 2.78%. By the end of 2010, annual real GDP growth reached 2.53%, an increase of more than 5% in only 3 years. Such a robust increase can only be attributed to quick government action. Quarterly growth is even more staggering, as shown below by a timeline of government action created by the Department of the Treasury. In addition, according to the Center on Budget and Policy Priorities, it is directly because of the U.S. fiscal response that the economy has averaged 2.1% annual growth since 2009, which clearly indicates that the pattern of growth has continued through 2017. The CBPP continues to cite the Congressional Budget Office, which found that GDP has been higher each year since 2009 than it would have been without recovery measures. While a steadily rising GDP is a sure measure of increased economic stability, so too are lowered rates of unemployment. The Moody's and Princeton model projected an unemployment rate of 16.5% in 2011 without the bailout, instead of the actual high of 10.1%. Over the course of 2009 to 2017, the Congressional Budget Office estimates that the unemployment rate has been lower since 2009 than it otherwise would have been had measures toward recovery not been taken. Today, the unemployment rate stands at 4.4% in April of 2017 from the high of 10% in October 2009, which indicates a normal recovery by Bloomberg LP standards. The most concrete example of the bailout at work is the recovery of the auto industry. According to Reuters and the Center for Automotive Research, the 2009 federal bailout of General Motors, Chrysler, and other parts suppliers saved 1.5 million U.S. jobs and preserved $105.3 billion in insurance collections. Former chairman of the Council of Economic Advisors and professor of economics and public affairs at Princeton had the following to say about the tough decision to bail out the auto industry. I am sure President Obama paid a large political price for his decisions at the time, but the economy is on a stronger footing as a result. The next important factor to consider when evaluating the positive impacts of the bailout is the lowered costs over the short term thanks to the quick government response. Rather than the projected need in 2008 of $700 billion to bail out the financial institutions most affected by the crisis, TARP required $475 billion by 2010. This decrease in need for funding signaled the first sign of lowered costs as banks began to quickly recover. While a risk remained high at the time that many financial institutions would fail regardless of a government bailout, the situation quickly turned around after the first injection of TARP and other funds into the financial system. By 2012, the government expected to at least break even on financial stability programs. Such programs included TARP investments in AIG, purchases of mortgage-backed securities, and the Money Market Fund Guarantee Program, as shown by the diagram below from the Office of Management and Budget of the Treasury. Quick returns from AIG in particular serve as the perfect example of why costs were covered almost immediately. AIG, if you recall, cost the U.S. government the most at $70 billion. The U.S. had bought 77.9% of its stock at $1 a share, and when the company bounced back, the U.S. had earned all of its investment back plus a profit of $15 billion, while still owning 16% of the company today, while its stock sells at $34. In total, $436 billion has been paid out to 970 recipients since 2008, and $390 billion has been returned to the Treasury in the form of dividend or interest payments and sales of equity as of April 2017. Separate investments into Fannie Mae and Freddie Mac total $187 billion to date, and the companies continue to yield profits, having so far paid back $266 billion in investments to the Treasury. Numbers such as these are particularly important because they highlight the low cost and high benefit of the 2008 bailout decision. That is not to say, of course, that these returns are a result of pure injection of money into the financial system. With the additional capital came additional regulation by the U.S. government, which put to a halt excessively risky business practices such as trading in the derivative market. And while some problems could not be solved by the bailout, according to the U.S. Small Business Administration, highly capitalized banks that benefited from TARP were less likely to extend loans to small businesses. Nevertheless, the bailout provided a necessary short-term stepping stone for the U.S. economy. While the decision remains unpopular in the public eye, the positive effects and successes of the bailout on GDP, on employment, on low costs, high returns on investments, all of these reasons justify the need to save financial institutions that are considered too big to fail. Thank you so much for watching, and I hope you enjoyed this presentation.